As the fiscal year draws to a close, it's that time of the year when you rush to make your tax saving investments. While it is always better to start your tax planning at the start of the financial year, we don't want to waste your time giving gyan. So anyway, let's begin this video with how we can save tax as well as create wealth. There are multiple ways to go about this, so let's discuss this in detail. A kind reminder is we will only talk about deductions under Section 80C of the Income Tax Act, in which individuals can claim deductions benefits on any investments, contributions or payments towards financial products and schemes. The first and the most popular would be the tax saving mutual funds, also called as equity linked savings scheme, which is ELSS. These are transparent, well regulated and offer good long-term returns. The tax exemption for ELSS funds is Rs 1.5 lakhs and has a lock-in period of 3 years. These investments are primarily in the equity segment and have delivered the best returns. 3 years at 29.3%, 5 years at 11.8% and 10 years at 15.57%. In terms of taxability, a capital gain in excess of 1 lakh in a year is taxed as LTCG at 10%. These investments are considered relatively risky as it invests primarily in the equity segment. ELSS have the shortest lock-in and the highest returns among all tax saving options. And you can also escape LTCG tax if you harvest it smartly. The second option is the Public Provident Fund or PPF. PPF has been a popular way of tax saving. The PPF has a maturity period of 15 years that can be further extended for 5 years. Premature closure and partial withdrawals are allowed after 5 and 7 years respectively. This delivers annual returns of 7.1%. The Government of India revises the PPF return rate every quarter, which is set based on the rate of returns on government bonds. PPF enjoys an EEE status, which is exempt, exempt and exempt. This implies that the contribution made towards the PPF account, the interest earned and the maturity proceeds are all tax exempted. A maximum of 1.5 lakh can be claimed under this. The third option is the National Pension Scheme. The NPS is a retirement benefit plan administered and regulated by the Pension Regulatory Fund Authority of India. It is a retirement planning scheme to generate monthly income during retirement period. Both the government and the private sector employees can leverage this. The lock-in period for this would be till 60 years with partial withdrawal allowed after 3 years. The returns generated here are 3 years at 26.3% and 5 years at 11.1% as on 17th March 2023. Contrary to common belief, you cannot withdraw the entire corpus of the NPS scheme after your retirement. You are compulsorily required to keep aside at least 40% of the corpus to receive a regular pension from PFRDA registered insurance firm. The remaining 60% is tax-free now. Taxpayers can claim an additional deduction of Rs 50,000 in addition to the overall limit of Rs 1.5 lakh under Section 80C. A fun fact here is the government allows to move the entire PPF corpus to NPS to enjoy better returns and flexibility. The fourth option is investing in the popular fixed deposits. Again here, you can invest in tax saving FDs and claim deductions up to 1.5 lakhs. The lock-in period is for 5 years, which means you cannot withdraw before the maturity period. Premature withdrawals are not allowed. Amid the interest rate hikes, the FDs are offering returns of 6 to 7.5% among big and small finance banks in India. TDS would be applicable on the interest earned on your FD. These would be taxed as per your tax slab. Additionally, you can reinvest the interest or opt for monthly or quarterly payouts. Tax saving FDs are just enough to beat inflation, making it not so ideal. The next scheme is the Senior Citizen Savings Scheme. In case you have already retired or applied for a VRS or the Voluntary Retirement Scheme, the Senior Citizen Savings Scheme can be an option as a risk-free tax saving investment. The lock-in and maturity period is 5 years and an extension of additional 3 years can be availed. Premature closure is allowed but with a penalty. The current interest rate is 8% and is backed by the Indian government. TDS will still be applicable in case the interest exceeds 10,000 per annum, and this scheme also entails a 1.5% penalty in case the account is closed before 2 years. While the next one is the National Savings Certificate. The NSC is a fixed income investment offered by the Government of India. This can be done by visiting a post office near you. The lock-in period is 5 years and the current interest rate is 7% per annum. The rate of interest on the Post Office National Savings Certificate is predetermined or fixed by the government every quarter. Additionally, the minimum investment amount to purchase an NSE certificate is Rs 100. Certificates are also available in various denominations like 10,000, 5,000, 1,000 and lower. The investment is considered safe as it is backed by the Government of India and ensures safety of your capital. The next one is the life insurance and ULIP, or the unit linked insurance plan. So talking about life insurance does not only provide full life coverage, but it is also the best way to save taxes. The premium paid on the policy can be allowed to avail tax deductions under Section 80C. Premiums paid to insure self, spouse, dependent children and members of HUF are all eligible. The annual premium up to 20% of the assured sum becomes tax deductible for a policy issued before March 31st, 2012, and 10% of the assured sum becomes tax deductible after April 1, 2021. A life insurance policy will provide your family financial support in case of your untimely death. The tax benefit is an added perk. Well, now talking about ULIP, ULIP is a similar but a wealth creation product and has a lock-in period for 5 years. ULIP provides market-linked returns of 8 to 10% along with insurance and tax benefits. You can withdraw funds partially after the lock-in period is over. Now, coming to the last scheme, it is the Sukanya Samriddhi Yojana scheme, which is a government scheme created with the intention to benefit the girl child under the initiative called Beti Bachao, Beti Padhao. The account in this scheme can be opened by the parent when the girl child is of 10 years or younger, and partial withdrawal can be allowed when the girl reaches 18 years of age and full withdrawal after the girl completes 21 years of age. This investment will provide returns of 7.6%. The limit for Section 80C investments is 1,50,000 with an additional 50,000 for NPS. While there are other ways by which you can save tax apart from the ones we discussed earlier, like medical insurance, home loan, charitable donations, education loans, etc., the ones we've discussed are the ones which will lead to wealth creation. Now coming to the taxability under the new or old regime, you can refer our old DITM dated 2nd February 2023 to see which regime suits you best. While I say this is me, Rahul Hassan, wishing you the very best and the start of this new fiscal year. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.